They say the devil is in the details. If that's true, then IRAs have a lot of devils. And maybe the devil with the biggest pitchfork is called the pro rata rule. I'm Kevin Gaines, American Financial Management Group. And a question we get often is, what do I do with contributions I make into a traditional IRA, but I didn't take the deduction? And this may sound like a weird situation that doesn't come up very often, but it comes off more than you think. And there are some easy ways where it can happen. The most common of which comes into play when you're talking about Roth IRAs versus traditional IRAs. Because with a Roth IRA, you put the money in, you don't take the deduction this year, and it grows tax-free or tax-deferred. And when you take the money out, you don't have to pay any taxes. The catch is you can only earn so much money before you're not allowed to make these contributions anymore. So if you want to add to an IRA and you earn too much money to contribute to a Roth, one of your options is to make an after-tax contribution into a traditional IRA. The income limits with traditional IRAs only apply to deductibility. It doesn't apply to whether you're allowed to make the contribution or not. So if you make these after-tax contributions, how do you figure out how much is taxable when you take your money out? Because you may say, oh, well, hey, I made these after-tax contributions and I'm taking my money, taking a withdrawal from my traditional IRA. Yeah, this is just those contributions. I just want to take those back so I don't owe any taxes. Not so fast. The IRS has actually set up a procedure on how to figure out which dollars are being taxed each year, each time you take out a distribution. And you can kind of think of this, if you will, as putting cream in coffee. Because once you put the cream in the coffee, you mix it up. Each sip, you're going to have some coffee and some cream. You can't pick how much of each sip is going to be cream and how much is just going to be coffee. Well, traditional IRA works pretty much like that, that each time you take money out of your IRA, it's going to be a mix of these after-tax contributions that you don't pay income tax on and everything else that you will pay tax on. So probably the best way to go about this is to show an example. So let's look at a $100,000 IRA. Big round numbers, keep the math simple. Well, in this $100,000 IRA, we have $10,000 in post-tax contributions and $90,000 in pre-tax contributions, along with growth and appreciation that's happened over the years. Now, it's important to remember that only the contribution, the post-tax contribution itself, you do not have to pay any more tax on. The growth from those dollars, you do still have to pay income tax on when you take the money out, along with the pre-tax contributions. So, the big numbers to look at here is this $10,000 post-tax contribution. This is what we have to figure out what to do. Well, the first step is to figure out a percentage. And this part's fairly straightforward. $10,000 post-tax contribution, $100,000 IRA, 10%. Well, what that means is the distribution we take, 10% of it, we do not have to pay income tax on. Okay, that seems fairly straightforward. So we can go with another example. Pull $5,000 from your IRA. We've already calculated the percentage, so we know it's 10%. 10% of $5,000, $500. $500 of this distribution, you do not have to pay tax on. Great. Here's where it starts getting a little more involved. Well, we've now pulled $10,000. We now pulled $500 of our $10,000 non-deductible contribution out. So we need to reduce the $10,000 by the $500 So we now have $9,500 that's considered this post-tax contribution that is not going to be taxable on further distributions. Well, here's the problem. That 10% is not set in stone. That's going to get recalculated each time. Each year we take a distribution. So yes, we pull out this money and we take another distribution a year later. If the IRA is worth $95,000, great, still 10%. But the IRA is probably not $95,000 anymore. It might be $100,000. It might be $90,000. So you're just going to have to do the math again and again and again. Each year, you're going to have to do this. Note I say each year, not each time you take a distribution, because here's quirk number 2 with the pro rata rule, which is when you make the calculation for your percent. Well, you might think it's when you take the distribution same day. Okay, no. You may also think, well, I know required minimum distributions are based off of the previous year's ending value. So do we use that? No. You actually use the ending value of the current year. So if you take a distribution, say February 15th of 2021, you will not do the math to figure out the percentage until December 31st of 2021, because that's the number you're going to have to use. Now you're still looking at, the 10,000 or 9,500, whichever numbers we're looking at, but that value is always in flux. So you need to use 12/31 of the current year. So yes, you will not know the percent until after you take your distribution. It's the way it works. Sorry. Now, you may say, okay, well, I'm still not really have to worry about this all that often, but so why worry about it? Well, what a lot of people like to do are called Roth conversions, in which you take money from your traditional IRA and you move it into a Roth IRA. IRS has no problems with this. They have no income limits on this. So what happens frequently is people who earn too much money to make a Roth contribution will do what's called a backdoor Roth conversion. And we'll talk about this in another video, go into the details. But essentially what happens is you make an after-tax contribution into your IRA, then you take those dollars and do a Roth conversion. The idea being you don't have any income tax because you never took the deduction on that initial contribution. The conversion results in no income taxes paid, which would be true unless you already have dollars in your IRA. And then we got the cream and coffee situation to deal with. So this is a situation that can come up a lot more frequently than a lot of people like to think. And, unfortunately, there is no easy way around this rule. It is what it is. So you need to be aware of it. And you need to understand that you're going to be keeping these records. Once you get $1 of after-tax contribution into your IRA, you're going to be keeping records until your IRAs are empty. Because, and this has actually happened with a client of mine, that the percent of exemption from tax got to be like 0.1%, a minuscule amount, but it still existed. And quite frankly, you already paid tax on the dollars. Do you really want to pay tax a second time? Most of us don't. So yes, while this might be, you might feel that it's cumbersome, remember, this is a methodology to make sure you're not paying taxes a second time. So there is a reward, I guess you would say, or a benefit for going through this effort. So if you have any questions about the pro rata rule or anything else, please reach out to us. either email. We have the contact information here below, and we'll be happy to answer any questions you have. And especially if you have a particular situation that you want to at least get a second opinion on before you make some sort of decision, please reach out to us. We're always happy to talk to you. Thank you. Have a good day.